Welcome back to Golden Rule Radio, your weekly recap of the precious metals markets and the markets closely related and even impacted by the metals, or that the metals sometimes are impacted by. So can I end a sentence in a preposition?
You can. I love your intros because you keep adding, like every week, there's an extra word that gets added on to the end of it.
Okay,
so this
good.
week's word is buy.
Buy.
Yeah.
All right. Well,
So
your charts are brought to you by Miles today.
Me today.
There you go.
Again.
So without further ado, let's jump into gold because it's a very fun chart week.
Yeah. I've been talking up 1909, 1910 for a while now. So we did finally hit that today. We hit it with a little bit of RSI divergence, both going back to the low in May compared to today, as well as even here short term. So we kind of had a couple different stacked reversals on the relative strength index down on the oversold side. So the assumption off of that, of course, would be it's very likely we see gold take a bounce. Bounce doesn't always mean reversal back up or reversal back down. It could just be a bounce as we're still in the June numbers. But I think what the key takeaway here on the gold chart is we're looking at the really shallowest possible position we could have expected a pullback from. I think it's important to remember that even just in the short term, we're talking about gold 1,600 to almost 2,100. Coming back down to 1900 is 2 steps forward, about half a step backwards.
That's right. No, I love this. Focusing on fundamentals, and we'll touch base on these a little bit later in the show, but when things are relatively unchanged and you're seeing these price discounts, one, it's seasonal. Two, it's absolutely justifiable just from a technical standpoint. When you overshoot, it's good to pause, take a breather, find a home, find a springboard, resume the bull market. As Kevin always says, this is a cyclical, bearish sort of little trend in a secular bull market, right? No interruption to the bull market here. So why not continue to hope for price discounts when what we do over time, whether it's twice a month, every month, quarterly, adding to your ounces, of course we want to lower the cost average. So use these opportunities. And if this doesn't hold, that's quite all right with me as well. I know that isn't fun for the gold owner to hear, somebody that's already invested. But again, take advantage of it. Doesn't matter if you already own it.
Yeah, well, and I think it's also important to remember what I think is the fundamental cornerstone aspect of any type of charting or any type of market move as a whole. And that's if markets worked perfectly, nobody would make money on them. Like the fact that they overextend in either direction is where you find those opportunities. So like Tori was mentioning, dollar cost averaging in, I've preached this for years. I buy gold every paycheck. I don't care what the price is. But I also put a little bit of money aside into a cash position for when we hit certain price levels to kind of stack the deck in my favor. So if you're like me and you've been dollar cost averaging at 2050, 2000, 1950. Well, now we're down to the 1909 number we've been talking about. Well, this is where I go. I'm going to dollar cost in. But over the last couple months, I also have a little bit of cash that I think I'm going to get in as well in sort of a non-dollar cost average kind of fashion because I see it as a heck of an opportunity. So having kind of multiple strategies in any market, I think makes a lot of sense because you want to both play the averages and play the opportunities.
Yeah, I like it. The moving averages continue to creep up. Are we going to meet and touch some of those? That's also key. Anytime we're detached from them, there's always going to be a point where you're touching them, whether the average comes up to touch the price or the price comes down to touch the average, who knows? But those are also very encouraging and reaffirming points of entry.
Yeah, and there's a lot of different indicators you can bring into chart work that I try to not clutter my charts too much for our show. But you can bring in stochastics and moving averages and Knoxville divergence and all sorts of other things that all kind of tell the same story. When you look at gold over a couple-year period, way overbought. And it had to have this pullback. And that's kind of why we've been saying, hey, start averaging in as we're pulling back, because you don't know how low it's going to go.
That's right. That's the issue.
What really scares me here is what if we put in a bottom today? Like, what if we went from 16 to 21 and all we did was come back to 19? Or you mentioned earlier, let's go pre-COVID. What if we went from 14 to 21?
Yep.
What if we went up $700 and all it did was come back 2? less than 200, like that's scary.
Well,
that is a scary bullish market.
But that's also what it's done over our lifetimes. In my lifetime, I've seen $35 gold, and now I've seen 2080 gold, or 1,935 now, roughly lower. But all that to be said, that's quite the portfolio performance. And we're not just seeing that in the U.S. dollar. Unfortunately, that represents the demise of the dollar. All fiat currencies get depreciated over time. The more you print, the worse the purchasing power becomes of that particular currency. The dollar is no exception. The weekly commentary this week does a great job of summarizing what's going on in some other currencies. Yes, the dollar is stronger than other currencies relative to. They're going to have to bail themselves out. No wonder BRICS is talking about either going on some sort of gold standard or forming their own currency together. It's no coincidence that the BRICS, which is Brazil, Russia, India, China, South Africa, you could throw Iran in there. They have currency issues too, but that's the real, the ruble, the rupee, the yuan, the South African rand. The yuan's the only one that doesn't start with an R. But anyway, just keep in mind that that is something that each of those have depreciated so much that over the last 20 plus years, just since 2000, they've decreased in purchasing power by 2,000% when measured in gold. Well, the U.S. dollar is, quote unquote, only down 600% when measured in gold. Well, they've got an issue on their hands, Miles. So they should back their currency with gold.
Sure.
I don't know if it's going to happen. Our talk is we're forming a Fed coin. We're forming a central bank digital currency. That's what a lot of clients are very concerned about, losing privacy, losing the ability to transact anonymously, removing third-party or counterparty risk on transactions, having cash for transactions. All of those things are protections provided by gold, and yet the timing is tough. People that want to have too great of a sense of urgency and doing it too soon, too aggressively, that's not wise either. But man, I'm thankful for this window of opportunity that we have here to add to ounces in gold. I love the charts. I love looking for support, but ultimately, those are much, much bigger deals.
Sure. Well, and my argument has always been this. As long as the government spends more money than they make and make up the difference with inflation, I will continue to own hard assets.
That's right.
Dirt and the stuff that comes out of dirt. It's just unfortunately an acre of dirt isn't that portable if I need to go sell it at a pawn shop or take it to a different state. So I'm always going to be a fan of the hard assets because we use an infinite currency to transact a finite amount of goods and services available. So storing your wealth within those tangible goods and services is always going to be my argument for a percentage of your assets. Gold's down a little bit. Great. I love that it finally hit a price that I've been hoping for. As we transition over to the silver chart, I think there's a good chance we may see gold in the next few days do what silver did. Silver came down to its 50% short-term retracement, immediately bounced up, and then topped out at the 382. So we had this perfect little fib bounce back and forth over the last couple days. I put a chart up last week showing a rising floor in the silver price. I think there's a good chance, since we're in the summer months, that we'll see some sideways trading, maybe between 21 and 23 in silver, as it kind of rides that line up, which should end up meeting around that 50% line like September, which September is a pretty good month to expect to see commodities start rising again. So we'll see if my speculative guess plays out here. But I think silver is maybe not quote unquote done, but I think silver is probably the decline is going to start losing steam as the train gets stopped and sort of looks the other direction.
When it hit that 22.13 level, I really thought, oh gosh, that was that support you were talking about. And then we're right back to just over 23. Well,
Right.
in the last few trading days, it hasn't moved hardly at all. I mean, 15, 20 cents here and there, either direction. And yet gold has declined, and that's increased the ratio. Well, initially, it increased the ratio to 86 because silver outperformed gold on the drop. Silver dropped more. In the last few days, gold has dropped more than silver. So the ratio's gone from 86 back down to 83 and now 84. So I'm with you. I can't wait to see what silver does. My eyes have really been more on silver, and when adding to portfolios, it doesn't matter if it's in an IRA or delivery, I'm encouraging my clients to absolutely take a silver position here.
Right.
Because of where the ratio is. If it comes back down and touches a 50% retracement, great. Yeah, you're saving 70 cents an ounce. that's a motivator. Primary motivator for me is the ratio.
Speaking of ratios, moving over to platinum, which last week I sort of threw my charts in the air because I'm over it. I'm going to continue that trend with platinum. Platinum broke below the 618 fib just barely, but touched it as a ceiling. I don't know. I just, I'm a preserve my money in gold and silver guy and own a little platinum just because, again, the ratio aspect long-term makes it make sense to me. I don't know. Ask someone else. I have no idea where platinum's going. I do just want to keep chipping away at it every time it goes down. But
but you already said why, because it's the ratio, right?
Yeah. I understand the ratio. I don't understand the dollar price.
Right. So that's what I'm saying is I buy off ratio. I don't buy off spot price. I love it when we see the ratio move in our favor and the spot price move in our favor. Now we're saving money, but more importantly, it's about that compounding ounce effect. And we're happy to talk about this with your portfolio on an individual basis anytime, but I'm not trying to get above heads here. But Miles, the palladium is the story. And I know you've got to get there. We're under 1,300 now.
Yeah, and maybe that's the point.
Yeah. A year ago, we were at 3,300 on palladium. So ratio-wise, it's like, no, we weren't buying palladium. We were selling palladium, moving into platinum. And platinum, albeit flat and touching a little bit of a support level here, the floor fell through palladium. So we've been on the right side of the fence. And I'm fired up that platinum's hanging in there. Anything to me above 750 is relatively bullish. We were just at 550 a year ago in platinum. So I'm pleased with it.
Maybe that's the argument, right? I mean, gold is slow and steady. You get the market moves, but they're not over dramatic. Silver is a little bit more dramatic, a little bit more aggressive. And then platinum is the little speedboat running laps around the Titanic. And maybe that's kind of the point here. But when you do break it down, not in terms of US dollars, but in terms of ounces of other products, it just still makes sense.
No, it totally does. And you're always one mining impact away from either of those having some huge swing. I mean, we're seeing that, with 80% of it mined in Russia and South Africa. Who knows what ends up happening with platinum at any given point, which is why it spiked last year on the Russian invasion of Ukraine. But we're seeing that now, this Wagner group, this paramilitary group that's basically been financed by Putin. I mean, the U.S. just came out and blacklisted 4 gold companies that it said have helped Wagner fund its operations in Africa and its forces in Ukraine. So they've been funding themselves with gold. Well, you talk about dirt. There's a dirt issue here. What comes out of the ground impacts our market, our niche, but it also kind of impacts the world because Wagner controls Central African Republic's biggest gold mine, producing as much as $200 million of gold annually. Well, if that all gets shut down and pinched out and discarded in the markets, where's this Wagner group getting funded? Because Russia's now cutting them off too. So eyes on the metals here with South Africa and with Russia. Geopolitically, we could have price spikes, and that could put the floor in these corrections.
Right. So moving over to the other markets, a tale of two twins separated at birth, raised in vastly different situations. When you sit the Dow Jones Industrial Average chart right next door to the NASDAQ, I think that's what we're looking at here. So very, very similar upbringing till about November of last year, where both of them had obviously the significant 2022 decline. Both of them had a little bit of a rebound. And then here we go. All you got to do is introduce a new potential technology and your tech stock sector explodes. So we brought this up last week. The NASDAQ obviously carrying the weight for the rest of the U.S. market because the Dow Jones has continued to just sort of be flatlined just under and can't get above that 34,000 mark, whereas the NASDAQ has gone all the way from 10,000 up to 14 and sitting just a couple thousand points but below the all-time highs put in at the beginning of last year. So two very differing charts, different ways to look at the market, and it's a heck of an argument to make that there really is one sector kind of propping everything else up because there's still the banking concerns. There's obviously still real estate concerns, especially in the commercial markets. There's one speculative thing that's carrying the brunt of the weight right now, and that always makes me nervous.
Yeah, eyes are going to have to be on economic numbers here. The expectation is that inflation actually should be increasing here because you do this 12-month rolling average, and we're getting ready to absorb the peak months into that average. But other than that, I mean, economic numbers are actually stronger than expected, but also more inflationary than expected. So as U.S. economic data comes in strong, we'll have to see what happens on the inflation front. Home prices are actually rising again month on month. So are there concerns? Yes. But people are just continuing to buy at higher interest rates for now. And yet that's not the case in Russia. They're doing yuan manipulation. Japan is doing yen manipulation. People are fighting all of this through currency manipulation, and we're not going to be any exception. Pretty soon they're going to have to weaken the U.S. dollar for obviously economic concerns like exporting our inflation and driving manufacturing and jobs. All of those are going to be necessary. At some point, the dollar gets its turn. So I know you wanted to close with some U.S. dollar conversation and see what you think's going on.
Yeah, you ever flick a quarter on a table and you watch it spin around for a while and then eventually it just kind of comes to rest? Well, that's definitely what the dollar's doing. So after the big rise up to about 116, here we are, 103. I think that's where the dollar's just going to park for a while. Can't get above 106, can't get below 100, so split the difference, 103. I think that's where the dollar's probably going to sit. And a couple of things could change that, right? We could have another major interest rate move. We could have another massive spending bill. Or something could happen in a large enough market to where it drives money into or out of the dollar, like the euro, like the yuan, maybe the British pound. Dumping treasuries, or some type of geopolitical event that causes people to move money into the equities. And both of those are possible. And as much as I hate to admit it, I think for all economic reasons, you would assume continued decline of the purchasing power, like you mentioned earlier, of the U.S. dollar. But we don't exclusively control the U.S. dollar here in the United States. And there are things that could be heating up, not within the walls of the United States, that might make some flight capital come our direction. And don't let that fool you into thinking that's actual purchasing power, dollar strength building here stateside.
That's right. Yes, you can have a decrease in purchasing power of the dollar and the dollar index going up. That's actually what you and I have witnessed the last 20 years. That's what's occurring. And so don't confuse the two. Stronger dollar index, but a loss of purchasing power. Death, taxes, and a depreciation of the purchasing power of the currency are all three guaranteed.
So that's going to do it this week for Golden Rule Radio. As always, we appreciate you stopping by. Do the YouTube button pushing thing if your heart so desires. But better yet, why not give us a buzz? We can talk with you about your personal portfolio. We can be reached at 800-525-9556. Our website is McIlvaney.com. If you'd like to learn a little bit more about the company, read or listen to any of our other weekly pieces that we put out. You can also find us on Twitter at ICA Gold or Facebook at McIlvaney Financial. Thanks again. Hope you have a great week.